The difference between a smart investor and a random speculator. The difference between a smart investor and a random speculator is that the former seeks value, while the latter chases prices. Do not invest in something just because its price is rising. Instead, invest in assets that have real long-term value. Investing is an art that requires patience, discipline, and a deep understanding of the market. However, not all market participants approach investing in the same way. The distinction between a smart investor and a random speculator lies in their mindset, strategy, and long-term goals. A smart investor seeks value, while a random speculator chases prices. This fundamental difference shapes their outcomes and determines their success or failure in the financial markets. A smart investor is someone who approaches the market with a clear strategy and a focus on intrinsic value. They carefully analyze assets, looking for those that are undervalued or have strong fundamentals. Their decisions are based on thorough research, including factors such as the company's financial health, growth potential, competitive advantage, and industry trends. For example, a smart investor might invest in a company with a strong balance sheet, consistent earnings, and a sustainable business model, even if its stock price is not currently trending upward. They understand that the market can be irrational in the short term, but tends to reflect true value over time. By focusing on long-term value, smart investors are able to weather market volatility and achieve steady, sustainable returns. On the other hand, a random speculator is driven by short-term price movements and market hype. They often invest in assets simply because their prices are rising, without considering the underlying fundamentals. Speculators are more likely to follow trends, rumors, or emotions, such as fear of missing out, FOMO. For instance, a speculator might buy a stock during a sudden price surge, hoping to sell it quickly for a profit. While this approach can sometimes yield quick gains, it is highly risky and often leads to significant losses. Speculators are vulnerable to market bubbles and crashes, as their decisions are not grounded in a solid understanding of the asset's true value. The key takeaway from this distinction is the importance of focusing on long-term value rather than short-term price movements. As the saying goes, do not invest in something just because its price is rising. Instead, invest in assets that have real long-term value. This principle emphasizes the need for patience and discipline in investing. Markets are inherently unpredictable in the short term, but over time, assets with strong fundamentals tend to perform well. By avoiding the temptation to chase prices and instead focusing on value, investors can build a portfolio that stands the test of time. In conclusion, the difference between a smart investor and a random speculator lies in their approach to the market. A smart investor seeks value, conducts thorough research, and focuses on long-term growth, while a random speculator chases prices and relies on short-term trends. By adopting the mindset of a smart investor and prioritizing real value over fleeting price movements, individuals can achieve greater financial success and stability. Investing is not about quick wins. It is about making informed decisions that align with long-term goals and principles.